I'm Bernard Hickey with the daily briefing from interest.co.nz. Today we'll report on the US Federal Reserve's rate cut and how that's boosted the New Zealand dollar through 79 US cents. We'll look at BNZ's latest move to increase variable mortgage rates and credit card rates. And we'll dig through the latest batch of economic news showing slowing housing lending but strong government spending growth. Firstly, we begin with news in early on Thursday that the US Federal Reserve has cut the federal funds rate by half a percentage point to 3%. The markets had expected a second rate cut in 2 weeks, but the shift is slightly larger than most had expected. That means the Federal Reserve has cut rates by 1.25 percentage points in 8 days. That's the fastest cut in 20 years. The Federal Open Markets Committee was not unanimous in their decision. There was one dissenter. But the Fed was insistent that financial markets remained under considerable stress and that credit had tightened for some businesses and households. It also pointed out there has been a deepening of the housing contraction and a softening in labour markets. Those are the words of a US Federal Reserve deeply worried about the prospects of a recession, and so they should be. We saw fresh data out early on Thursday showing the US economy grew at an annual rate of 0.6% in the December quarter. That was half what economists had forecast. Many are now saying the US economy is already in recession. All this means is that New Zealand's official interest rates are now 5.25 percentage points above US rates. That makes our currency that much more attractive for international investors hunting for high yield. Currency traders took about 10 minutes to work this out this morning and pushed the New Zealand dollar over 79 US cents, although it's backed off a bit since then to about 78.5 cents. New Zealand's interest rates look to be on hold for now, but in the US, investors are already factoring in another 50 basis points. When the Fed committee meets again in March, that would mean a rates differential approaching 6%. You'd have to say it's 80 cents, here we come. Now back at home, the Bank of New Zealand has taken the lead and increased its variable mortgage rate and its credit card rates. It's blaming the higher cost of short-term wholesale funding. However, it has also cut its longer-term fixed mortgage rates to beneath those of its major rivals. The BNZ is the first of the major banks to lift its variable mortgage rate, increasing it by 14 basis points to 10.69%. Now, the banks have not lifted their variable rate since the Reserve Bank last lifted its official cash rate back in July, and since then, wholesale 90-day bill rates, which are the basis for variable rate mortgages, have increased between 25 and 50 basis points to about 8.75%. But the Bank of New Zealand has cut its 5-year mortgage rate by 10 basis points to 8.89. That means BNZ is now the lowest of the big four, with ANZ National, Westpac and ASB at 8.95. Kiwibank's 5-year rate, however, remains below them all on 8.75. BNZ has also moved its standard 2-year fixed mortgage rate to match ASB on 9.5%. You might remember that earlier this month, ANZ National, Westpac and BNZ all tried to increase their 2-year fixed rate by 20 basis points to 9.6%. However, Kiwibank and ASB decided not to follow, and that appears to have been a factor in first ASB, then Westpac, and now BNZ into nudging their 2-year rates back to 9.5%. ANZ and National are still on 9.6. This 5-year zone has developed as the key battleground in a slower housing market. Home buyers are increasingly looking for the lowest headline rate in an environment where disposable income is under intense pressure. BNZ also took the unusual move of lifting almost all its credit card rates by 100 basis points to 21.95%. Only its light rate of 12.95 is unchanged. And finally, let's look at some stats through in the last day showing housing lending slowing along with the rest of the housing market. This shows housing lending growth slowing in December to 12.7% up from a year ago. That's down from the 13.3% annual growth rate in November. Business lending has also slowed sharply. The rural sector, though, is going gangbusters. Growth there rose 14.6%. The farmers don't look like they're using their dairy payout bonanzas to pay off debt. If anything, they are borrowing more and faster so they can buy each other's farms for increasingly higher prices. And briefly, let's look at the government spending and taxation figures just through from the Treasury early on Thursday. They show government spending money even faster than they're taking it in. Core Crown revenues, that's taxation, grew 5.2% in the 5 months to November 30 from the same period a year ago. But core Crown spending grew 9.7% in the same period. So government spending is not only growing twice the rate of taxation growth, but it's growing twice as fast as nominal GDP. That means the government is growing faster than private sector and sucking in resources so fast it is increasing prices and many believe reducing productivity. Surely a political issue in an election year. I'm Bernard Hickey from interest.co.nz with the Daily Briefing. Catch you tomorrow.